Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, I want to do another episode on second quarter earnings. You know, the markets have been a little volatile, but generally moving higher. And while there's been tensions, things like the Middle East, really what's been driving it to a decent degree is ever growing earnings, right? And so we actually published a little over a month ago on the same topic as the earnings season kicked off, and we're getting not quite done, but pretty close to done on the results that came from the reports on second quarter. And recall that we had talked about a high bar being set, like there was growth anticipated. And the punchline is that as we see things unfold, it looks like the numbers are actually even better than were expected. And so think of it as those expectations being met and exceeded. And of course, that sets up for the future. It sets up for a little bit more of an unpacking on why that happened. Are there any specific things that drove it? And kind of where we go from here. So let's jump into it. So that blended earnings growth rate, annualized growth rate, is over 50%. And that compares to the number, believe it or not, 23%, or 23.1 was expected when they surveyed everybody as of the end of June. So that, think of it as the consensus forecast. So it's not really a survey, it's the buildup of analyst work. And that's really, that over 50% is the strongest rate since the second quarter of 2021. 10 of 11 sectors reported growth, with 8 of those posting double-digit growth. Now, there was one important sort of unusual event that came out, and it really related to both Alphabet and Amazon. And in each case, they recorded unusually large income gains, basically. Think of it as gains on investments. And so investment gains maybe is a better way to say it. And it's so you can kind of think of it as different in each case. In the case of Alphabet, almost $100 billion, $98 billion sort of attributed to other income gain, which is primarily gains, unrealized gains on equity securities. And then with Amazon, over a $50 billion gain, primarily related to its investment in Anthropic, which has been really doing well in terms of growing and building their revenue base, and corresponding to that would be a sort of a mark up in the value of equity. Now, so if we excluded those two companies, their entire earnings, that growth rate, instead of over 50%, would be 32%, which is still a really good number. And then I would say the other thing is that the earnings surprise, like what, just think of it as the positive effect would still be positive, but not quite as much. And so the other thing that's been sort of bantered about a little bit is whether these earnings have been supported by tariff refunds. So recall the Supreme Court ruled that tariffs shouldn't have happened, so that basically companies can go and get refunds. But the punchline here is, while numbers are a little bit hard to gather, the general view is that we're talking single digit, probably mid-single digit effect in terms of tariffs. So the idea is that it's there, but not a meaningful explanation of these good results. Now, when we look at blended sort of revenue growth, so think of it as the top line of results. The revenue growth number was 15%, and that's better than what was expected at the end of June. The forecast for this quarter was just over 12%, and actually at the end of March, it was just under 10%. So there's this build up of optimism really around also revenue growth. And all 11 sectors in this case reported positive growth, with 5 of those achieving double-digit numbers. And so, basically strong profit growth has been, driving, it's a kind of a combination of the revenue and good profitability driving earnings. So all of that, all in all, pretty positive. Now, when people take a step back and talk about why this is happening, of course, the AI build out is still in keen focus. So semiconductor revenues, hyperscaler growth, demand for chips, for data centers, for cloud capacity and related infrastructure. So that's all still explaining a lot. And then, I'd say the final quick comment is to say it's a common thing in a situation like this then to look at how things are building. Well, what are we seeing when it comes to the expectation given everything that's happening for the third quarter? And honestly, sometimes what happens is you have growth go better than expected, and it kind of comes out of the future. It means that the growth in the future might dampen a little bit because the earnings, if you will, are pulled forward. But right now we're seeing actually numbers still pretty positive, an expected earnings growth rate for the third quarter of over 27%, and for the fourth quarter over 25%. So it's just this, really undercurrent of optimism. And again, just to get back to the original comment, and that's driven markets higher. Markets are, in my view, a little bit, what I guess the term some people use is toppy, meaning they're a little bit overvalued. The markets have been looking through the kind of the tensions in the Middle East. They've been celebrating this earnings growth. And so markets have gone higher, but we sit in an environment where any kind of disruption could be an external event, maybe a disappointment when we get to third quarter, maybe the earnings growth doesn't do quite as well as they're expecting. Anything like that could cause the market to sort of shake a little bit, maybe see a little increase in volatility, maybe the chance of a pullback. Of course, as ever, we don't talk about that in terms of market timing. We think long-term investors should stay invested, but it's really about being ready for that volatility and the recognition that sometimes after especially a move like we've seen recently, markets going higher, that markets can pull back, and that's all part of the process. And as long-term investors, you ride it out. So anyway, that's what we wanted to cover in this summer episode. So really appreciate you taking the time to listen, and we'll catch you on the next episode. Thanks so much.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.